Let me tell you something that's been bugging me for the past 3 months. Every single conversation I've had with investors this year, whether it's a friend texting me at 11 p.m. or a comment thread going 400 deep, it's the same question. What's the one stock that hasn't run yet but absolutely should? And look, I usually hate that framing. The one stock, it sounds like a lottery ticket pitch. It sounds like the stuff that gets people burned. But here's the thing. Sometimes, not often, but sometimes the answer is actually obvious. The setup is clean. The fundamentals are there. The macro wind is blowing in the right direction. And the market just hasn't figured it out yet. I think we're in one of those moments right now. And today I'm going to walk you through exactly why I believe one specific company, trading at a fraction of what its peers are worth, could be the single biggest winner the rest of 2026 has to offer. This is not hype. This is not a Reddit play. Stick with me, because the thesis here is genuinely one of the most compelling I've seen in years. Before I name the stock, I need you to understand why this moment in 2026 is different. We are in the middle of what I'd call a selective bull market. The indices are up. A handful of mega caps are carrying the whole thing, but underneath the surface, there is an entire layer of quality companies that got absolutely crushed in the rate hike cycle, never fully recovered, and are now sitting there like coiled springs, strong balance sheets, accelerating revenue, and nobody paying attention. That's where this story lives. Now, here's the specific setup I look for when I'm hunting for an asymmetric opportunity. Number one, the company operates in a sector with undeniable tailwinds. Not speculative tailwinds, real measurable dollar-denominated demand that's already showing up in the data. Number two, the stock is down 40%, 50%, 60% from its highs for reasons that are either already resolved or in the process of being resolved. Number three, insiders are buying, or the company is buying back stock aggressively, or both. Number four, there's a specific catalyst on the horizon. Not the market will eventually appreciate this. A real datable event that could force a re-rating. The stock I'm about to walk you through checks every single one of those boxes. Here's what I want you to picture. You're a pharmaceutical company. You've got a drug that took 11 years and $2 billion to develop. It just cleared phase 3 trials. The FDA submission window is open, and your regulatory team is working off a system that was patched together from 3 different platforms, none of which were built for this specific workflow. One compliance gap, one missing document in the submission package, one data formatting error that a reviewer flags on a Tuesday afternoon, and suddenly you're looking at a 6-month delay on a drug that patients are waiting for. That is not a hypothetical. That happens regularly in an industry where every month of delay costs tens of millions of dollars and sometimes costs lives. Now multiply that across every pharma company, every biotech, every medical device maker operating in the US right now. Multiply it by the FDA's increasingly complex submission requirements. Multiply it by the fact that clinical trials are getting more sophisticated, more data heavy, and more globally distributed every single year. The compliance and data infrastructure problem in life sciences is not getting smaller. It is getting dramatically bigger. And the company that owns that infrastructure, that's who wins. The company is Veeva Systems, ticker VEEV. Now, before some of you click away, I know Veeva isn't new. It's been a public company since 2013. People have covered it. Analysts have modeled it. Institutional investors own it. So why am I calling it the biggest winner of 2026? Because Veeva just spent 2 years going through one of the most misunderstood transitions in enterprise software history. And that transition is almost done. And almost nobody's pricing in what the clean version of this company looks like on the other side. Let me explain. Veeva's core product is called Vault. It's a cloud platform built specifically for the life sciences industry. Clinical data management, regulatory submissions, quality control, commercial operations. If a drug goes from a lab to a pharmacy shelf, there's a very good chance a Veeva product touched that process somewhere along the way. Their customers are not small. We're talking Pfizer, Johnson & Johnson, Novartis, AstraZeneca. These are companies that spend aggressively on software because the cost of a compliance failure is not just financial. It's regulatory, it's reputational, it's existential. So what's been the problem? For years, Veeva built its CRM products. The tools pharma sales reps use to track doctors, manage relationships, log calls on top of Salesforce's infrastructure. It was a partnership that made sense early on. But here's the awkward reality. Salesforce competes directly with Viva in life sciences. Viva was essentially paying rent to a competitor and giving them a front row seat to their customers. So Viva made a call. That took serious guts. We're going to rebuild our entire CRM layer from the ground up on our own. Vault infrastructure. No more Salesforce dependency. Full control of the product roadmap. Higher margins. And a dramatically stronger switching cost for customers. That migration, moving thousands of enterprise customers from Salesforce-based Viva CRM to the new native Vault CRM, is what spooked investors. It created uncertainty. It created the perception of execution risk. It created the discount that exists today. Here's what investors are missing. The migration is more than halfway complete. The customers who've already moved.
Retention is strong. Satisfaction scores are up. The new product is legitimately better. And the companies still in migration have already committed. They're not going back to Salesforce. The risk that everyone priced in is quietly dissolving quarter by quarter. Let me give you the operating picture, because this is not a story stock. The fundamentals are genuinely excellent. Operating margins are consistently in the high 20s to low 30s. For a software company growing revenue at a double-digit clip, that is a serious number. Most software companies at this growth rate are burning cash. Viva is printing a free cash flow has been strong for years. This isn't a we'll be profitable eventually situation. Viva makes real money right now. Net revenue retention, meaning how much existing customers spend year over year without counting a single new customer, sits above 110%. Let that sink in. Even if Viva signs 0 new contracts next year, the existing base would still grow revenue by double digits just through expansion.
And the remaining performance obligations, the legally committed future revenue already contracted but not yet recognized, have been growing. That's not analyst projection. That's money that is already spoken for. Now the valuation. Viva trades at roughly 30 to 35 times forward earnings right now. On the surface, that sounds rich, but compare it to comparable enterprise software businesses, similar growth, similar margins, similar customer stickiness, and Viva is actually at a discount. Why? Because of the migration overhang. Because the story has been noisy for 2 years. Because investors got tired of waiting. When the story gets clean, the multiple expands. That's the re-rating thesis. It doesn't require heroic assumptions about growth. It just requires the uncertainty to go away. So what actually moves this stock? What are the specific things I'm watching? First, the migration finish line. When Viva announces that the CRM transition is substantially complete, a massive cloud lifts. Analysts who've been applying a discount for migration risk will have to revisit their models. That doesn't happen gradually. It happens in one earnings call, one quarter where the numbers are clean and the narrative is simple. Second, the biotech funding recovery. When rates went up, biotech funding collapsed. Smaller life sciences companies, a meaningful slice of Viva's customer base, froze spending. That cycle is reversing. Private biotech funding is coming back, and the FDA approval pipeline is healthy. Every new company that clears a funding round and enters the clinical stage eventually needs Viva's compliance. That demand backlog is starting to flow through. Third, AI monetization. I know every company is saying AI right now, and most of it is noise, but in Viva's specific case, there is a genuinely compelling application. AI-assisted regulatory document generation, automated adverse event detection in pharmacovigilance, AI-powered clinical trial data analysis. These aren't features on a roadmap slide. Several are already in closed beta with major customers. The moment those features move into standard pricing tiers, you're looking at a meaningful expansion of revenue per seat. Fourth, international. Viva's penetration in Europe and Asia is still substantially lower than in the US, despite the fact that the regulatory complexity in those markets is just as high. That's a second growth engine that hasn't fully kicked in yet. When it does, it doesn't show up as a single big quarter. It shows up as a persistent tailwind over years. I'm not going to pretend this is a risk-free idea. It isn't. The migration could drag. If the CRM transition takes longer than expected, or if a meaningful chunk, Salesforce isn't walking away. They know exactly what Viva is doing. They have deep pockets, deep relationships, and a strong incentive to win back life sciences accounts. Viva will lose deals. The question is whether the moat is wide enough to keep the core base intact. I think it is, but I could be wrong. And if macro conditions deteriorate, if rates spike again, if biotech funding dries up again, the smaller customers in Viva's base will tighten. That's not a company-specific risk. It's an industry cycle risk, but it's real. Here's how I think about those risks. They're all priced in. The market is valuing Viva as if these problems are permanent features of the business. I believe they're temporary. That gap between what the market is pricing and what the business actually is minus is where the opportunity lives. Look, I'm not telling you to go buy anything. You're the one taking the risk. You have to do your own work, read the filings, sit with the thesis, push back on it. But here's what I keep coming back to. Viva is a dominant platform in a non-optional industry. Healthcare and life sciences don't get disrupted. They get more regulated, more complex, and more dependent on exactly what Viva sells. The transition that scared everyone away is almost over. The customers who went, and ow, it didn't leave the numbers underneath the noise are excellent, and the stock is sitting at a discount it hasn't traded at in years. That combination doesn't come around often. The investors who will look back at December 2026 and say, I can't believe I sat on my hands, they're watching this video right now. They understand the thesis. They agree with the logic, and then they wait until it's obvious. And when it's obvious, it's already run. Don't be that person. Do your homework. Think for yourself, and I'll see you in the next one.